Hello, my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead.
LME 3-month copper. The late February to late March bullish Andrews pitchfork, highlighted in dark blue on my daily chart, drove this market higher throughout April and into mid-May, making new all-time highs. However, this beautiful, if very acute, bullish Andrews pitchfork eventually shot too high and made a V-top over the middle of May, eventually punching up through the top of the pitchfork before turning back down and busting down through the bottom of the pattern. Below at the time was the previously often mentioned congestion zone, 97.50 to 99.95. This time on the way down, the market did not really hesitate there as it did back at the turn of April into May on the way up, but punched down through it, and also down through the green highlighted short medium moving average, currently at 99.56. Below now for the last 2 and a bit weeks is the next congestion zone between 93.95 to 96.06, with a smaller one thereafter between 91.83 to 92.56. Now between these two congestion zones is the medium moving average, currently 93.73. In the process of moving lower, the market exited one pattern and straight into another, from a bullish Andrews pitchfork into a bright red highlighted narrow descending wedge pattern. And that's currently 91.84 to 94.73. Both this bearish descending wedge pattern and the bullish Andrews pitchfork are quite acute patterns. So as I said over the last 2 weeks, and I quote, until this bright red descending wedge pattern is broken or morphs into another pattern, then it will only run the move lower. End of quote. Well, last week the market broke up through the upper trend line, but, and this is an important but it has not really done much since, other than be caught between the overhead congestion, 97.50 to 99.95, and the congestion below between 93.95 to 96.06. Now, how could it be that the market is deciding which way to go, weighing up the relevant forces in each direction? But I'd like to put also another idea in front of you, and it is this. The whole V-top action from February to date may not be a simple V-top, may not even be complete. It may be a V-top with an extension. In these types of V-tops over the peak, the market may start moving lower, but then form a hesitation or a congestion of some sort, usually a pennant or a bear flag type pattern on the way lower. This might be the case here. So I would suggest holding fire and writing off and retiring the blue pitchfork or the red wedge pattern until the current move sideways sorts itself out. Or it could, after all, be just a hiccup on the road lower. LME 3-month aluminium. Now please excuse the red highlighted text of my daily chart. Sometimes my charting system decides to throw a wobbler for no apparent reason, and this is one of those times. So the red text is not necessarily anything special. So back to the LME aluminium market, and the move higher over March, April and even May originates back in late February, the market breaking higher from a diamond pattern type formed between late October 2023 to late February 2024. Now I grant you it was not the best looking diamond pattern type, but as I've repeatedly said back then and ever since, it had merit. However, the market took its own sweet time in moving up to the top side targets, but get up there they did. The next feature was the big spike higher on the 15th of April that ended up with an indecisive doji cross of all things. This huge move showed the topside potential of the market for the next few weeks. As part of this move higher, we had a gap move up over the weekend between the 12th to the 15th of April. We spent the rest of April and early May gradually moving down to fill in the gap, which was done early 6 weeks ago. Prices then started moving back up through the high on the 15th of April at 27.28. 4 weeks ago, the market made new recent highs, but at the same time sowed the seeds of its own bullish destruction by making a 2-day pipe top that was also part of a larger 2-week horn top. We've moved down ever since. Now, the move lower, which includes a small bearish halfway hesitation formed at the start of June and was in the shape of descending wedge pattern, that's currently 23.69 to 24.22. It is a quite narrow and very acute. Because of these factors, I've chosen not to highlight it, as it would obscure the pattern with the market. Last week I said, and I quote, prices are now entering a wide congestion band between 24.37 to 25.15, which looks quite disconnected, a quite disconnected zone, but in truth does work together. What is most important about this zone is that it's the beginning of a move down from the second of two patterns. It's a large, mid-April to date, possible double top pattern, Adam and Eve type. I call it a potential pattern as the neckline for this double top is around the 25.08 to 25.15 area, and though we have penetrated it, we have not as yet had any consecutive closes below it. But if it does, then this pattern will, as I said last week, so that's 2 weeks ago, I said last week, and I quote, will determine the next phase of the market, end of quote. Without formally calling them as potential pattern targets, I can give some idea of the destination and moves should they can be confirmed in the coming week. Thus, the primary target will be in the 2400 zone, with a secondary hard to reach target in the 2300 zone. End of quote. So that is a long quote, but it details what is happening now and where the opportunities are. Since my last commentary, the market has exited sideways out of the descending wedge pattern. However, there has been no immediate resumption of the moon lower or higher. Prices have gone mainly sideways, and this may be a clue as to what is happening next. You see, this move could be a hesitation or even a handle to the late May pipe top that may be a V-top in disguise, much as we have in the other metals. So I'll hold off changing or retiring any of the potentials until I see what develops in the most recent market action. I would also add, keep a close eye on the potential neckline for the double top in the 25.08 to 25.15 area. LME 3-month lead. I said 14 weeks ago here, and I quote, I suspect the key overhead resistance will be the same as in late January, the congestion between 21.82 to 21.89. That's 14 weeks ago. And that's the end of the quote. Please remember this quote, or rather remember that 21.82 to 21.89 level, as it will become relevant again. Okay, so the elephant in the room, as I have been calling it for 6 weeks now, is the bright red highlighted mid-February to late March bullish Andrews pitchfork. In late May, the market breached the upper tie, currently at 24.10, but it repaired itself, or so it seemed. But the breach allowed a bearish infection to set in that ended up being a horn top over late May, which was the high point of the recent move upwards. Moving into June now, and we have seen prices fall. 3 weeks ago, the market breached the neckline of the horn top. By the end of that week, had punched down through congestion from around two significant 50% Fibonacci line supports. The one for the whole of 2022 at 22.25, and the one for the June to October 2018 move at 22.21. In doing so, the market also reached the primary target for the horn top at 22.15. and the secondary harder to reach target in the 21.73 zone. 2 weeks ago, the drive lower moved prices down towards the next congestion, a wide band originating from April between roughly 21.86 to 21.35, which has three 50% Fibonacci lines within it. The November 2023 to May 24 move at 21.76, the May 23 to May 24 move at 21.67, and down at the lower end, the March 2020 to March 2022 move at 21.35. In addition to these, We also have the bright red lower time, currently at 21.96, plus the mauve highlighted medium moving average, currently at 21.56, and the gold highlighted long moving average, currently 21.43. So there's a lot underneath the market at the moment. The process of driving lower, in that process, the market formed an acute, narrow, dark blue highlighted bear channel. Currently that's 20.88 to 21.63. I said 2 weeks ago, and I quote, until prices break out of this dark blue bear channel or morph into some other pattern, then this bear channel will run things, end of quote. Well, last week the market staged a breakout upwards. Prices moved up towards the overhead resistance band between 22.13 to 22.25. Didn't like it up there and then moved down towards the whole combination of supports between 21.86 to 21.35, and seemingly doesn't like it down there that much either. So what have we? Well, we have a ping pong between two congestion areas, with no one being the clear leader. This very recent action might be the extension, such as we've seen in the other metals, an extension to the topping action seen over late May and early June, and possibly a bearish halfway hesitation in the making as well. Hence, much as the other metals do not write off, I did not write off or retire the major pattern features here, do not write off or retire the bright red bullish Andrews pitchfork or the broken dark blue bear channel until we see what may become of these recent moves.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.